Welcome back to Jackalyze, where analysis meets instinct. Today, we're diving into GDP and the economic cycle, because if you want to understand currencies, you first need to understand how economies grow, slow down, and recover. What is GDP? Gross Domestic Product, GDP, is the monetary value of all final goods and services produced within a country. When we talk about growth, we mean real GDP, the inflation-adjusted measure showing whether the economy actually produced more, not just that prices went up. For traders, GDP is essential. Sustained strong growth supports a currency. Persistent weakness often pushes it down. Think of GDP as the heartbeat of an economy. Like businesses, economies move through cycles, sometimes expanding and thriving, other times contracting and slowing. As traders, our edge comes from spotting where each economy sits in that cycle and positioning ourselves on strength versus weakness. The 4 stages of the economic cycle. Stage 1. Expansion. Expansion begins once the economy moves past the worst of a downturn. Activity picks up, businesses invest, hiring rises, incomes and spending grow, production increases, confidence improves. If this continues, GDP shows sustained positive growth. In stronger cases, it turns into a boom, spending and investment accelerate sharply. Stage 2. Peak. At the peak, growth reaches its high point. Indicators flatten, prices are relatively high, consumers and businesses begin to pull back. This is the turning point before the slowdown. Stage 3. Contraction. After the peak, momentum fades. GDP growth slows. Demand weakens, output and wages decline, prices may soften. A deep contraction turns GDP negative, a recession. In severe cases, it becomes a depression. At the trough, GDP is at its lowest. Stage 4. Recovery. From the trough, the economy starts to recover. Lower prices and improving confidence encourage spending and investment. Production ramps up, employment rises, the cycle resets, and steady growth returns. GDP data in FX trading. In Forex, GDP releases are core fundamentals. They show real changes in activity. A few key points every trader should know. 1. Real versus nominal. Always focus on real GDP. 2. Where to find it. Most countries publish GDP through their central bank or statistics office. For traders, global platforms like Forex Factory consolidate and update data. 3. Market reaction. A strong GDP report doesn't always mean a strong currency. Traders react to how the number compares to the forecast. Stronger than expected performance could lead to a rise in the currency. Weaker than expected performance could push the currency down, even if the number is positive. 4. Reporting format. Quarterly. Best for spotting trend changes. GDP is usually quarterly. Yearly. Smooths out seasonality and shows the bigger picture. Monthly. Highlights short-term momentum but tends to be noisier. Looking at these together shows whether an economy is gaining speed or losing it. Why traders care about the economic cycle. Currencies follow economies. GDP tells us where a country is in the cycle: expansion, peak, contraction, or recovery. Here's the strategic edge. The market reacts to relative growth. When one economy accelerates while another slows, divergence often shows directly in currency moves. A practical workflow. Compare economies using GDP. Place each one in its cycle. Translate that into a market bias. Trade by buying relative strength and selling relative weakness. GDP isn't the only factor, but it's one of the clearest maps of where an economy is heading and why its currency may follow. Remember, GDP isn't just a number, it's the heartbeat of the economy, and the cycle is the rhythm currencies move to. At Jackalyze, we break down fundamentals step by step, for clarity, not guesswork. Subscribe now, and stay tuned for the next session. Patience of a jackal, precision of a trader.